A freelance marketing consultant works from home 3 days a week at a desk in her living room. Her kids do homework at that same desk in the evenings. She claimed a home office deduction on her Schedule C. Under IRS rules, she is not entitled to it. The desk is not used exclusively for business. It is used exclusively for business only on the days when it is used exclusively for business, which does not satisfy the requirement. The exclusive use rule is not flexible, and the IRS takes it literally. The home office deduction is governed by Section 280A of the Internal Revenue Code. To qualify, a portion of your home must be used regularly and exclusively for business, and it must be your principal place of business, meaning it is either where you primarily conduct business or where you exclusively meet clients or customers. The requirement is not that you work from home regularly. The requirement is that the specific space you are claiming is used for business and nothing else. The Tax Cuts and Jobs Act of 2017 eliminated the home office deduction for employees, specifically the miscellaneous itemized deduction that W-2 workers could previously claim for unreimbursed employee business expenses. Since 2018, employees who work from home, even full-time, even by employer mandate, cannot deduct their home office expenses. The deduction is now available only to self-employed individuals and small business owners who file Schedule C, Schedule F, or as a partner in a partnership. There are two calculation methods. The simplified method allows you to deduct $5 per square foot of your home office, up to a maximum of 300 square feet. The maximum deduction under the simplified method is $1,500. It requires no records beyond the square footage of your office and the total square footage of your home. It cannot create or increase a business loss, meaning if your business income is $1,200 and your other deductions bring income to zero, the home office deduction under the simplified method is limited to $1,200. The regular method calculates the deduction based on the actual expenses of maintaining your home. You determine the business use percentage, typically the office square footage divided by the home's total square footage. You then apply that percentage to eligible home expenses, mortgage interest or rent, homeowner's insurance, utilities, repairs, and depreciation. If your home office is 12% of your home's total square footage and your annual mortgage interest is $18,000, your deductible portion of that expense is $2,160. The depreciation component of the regular method creates a consequence that most home-based business owners discover only when they sell their home. When you claim home office depreciation, typically calculated over 39 years on the business use portion of the home's value, that depreciation must be recaptured as ordinary income when you sell the home. The Section 121 primary residence exclusion, $250,000 single, $500,000 married, does not cover the depreciation recapture. A homeowner who claimed $12,000 in home office depreciation over 10 years will owe tax on that $12,000 at ordinary income rates upon sale. The exclusive use requirement is the most common compliance failure. Exclusive means exclusive. A bedroom that doubles as a guest room does not qualify. A kitchen table where you work in the mornings does not qualify. A dedicated room with a door that is set up solely for business, used only for business, and from which personal activity is genuinely excluded does qualify. The IRS has consistently held that even occasional personal use of the space, one family movie watched per month on the office monitor, defeats the exclusivity requirement. The audit risk profile for home office deductions has improved significantly for legitimate self-employed filers. The IRS used to flag home office claims at high rates, but data-driven audit selection has made the deduction less of a standalone trigger for Schedule C filers with consistent income and proportional deductions. The risk remains higher for filers who claim a home office deduction while also showing a net loss on Schedule C. The combination suggests an activity that may be a hobby rather than a business, which the IRS treats differently. For most home-based sole proprietors, the choice between the simplified and regular method comes down to office size and home expenses. A 200-square-foot office generates a $1,000 deduction under the simplified method. Under the regular method, if that office represents 10% of a home with $30,000 in annual housing costs, the deduction would be $3,000, though it would include depreciation, recapture exposure on sale. Calculate both methods each year. You are allowed to switch methods annually. The simplified method eliminates depreciation, recapture entirely. If you are self-employed and you work from a dedicated room used only for business, the home office deduction is yours to take. Measure the room. Calculate the percentage of your home it represents. Decide whether the simplified method or the regular method produces the better outcome for your situation, and factor in the depreciation recapture exposure if you use the regular method and own your home. If your office is a shared space, even occasionally, do not claim the deduction. The risk of an audit finding is not worth a deduction that the law does not actually permit. If this stayed with you, the sole proprietor to LLC video goes further. It covers when the switch actually makes sense and what truly changes when you make it, beyond the paperwork most guides stop at. It is on this channel, and it is the structural decision sitting underneath every deduction on your Schedule C.